Investment Advisory Committee meeting of January 25th, 2024. I will call this meeting to order. And I think we will have a roll call of members, and who might bring the roll call?
I can do that.
All right, thank you. Treasurer Combs.
Executive Ronayne,
Here.
Councilman Schron,
Here.
and I am here also, Treasurer Brad Cromas. All present.
And thank you for the three-hole punch.
Thank you.
Thank you.
Yeah.
Goes right in the notebook. Thank you.
We still have the technology, Councilman.
You use the paper
Correct.
punch.
Yeah, exactly. It's still up there. All right, well, what we're going to do is we're waiting for our partners at Meter to join us. We're going to do some other order of business, and they may have just joined. Good, they did. Hello, Meter team.
Good morning.
Good morning. Thank you. We just got started. So let me ask first for an approval, or if you've had the chance, members, to review minutes prior meeting November 2nd, 2023. I could take a motion. All right.
Approve.
Do we have a
Second.
Second. Is there any questions, revisions, changes, or comments? Okay, then if none, all in favor?
Aye.
Aye.
Any opposed? Okay, good. All right, meeting minutes of November 2nd, 2023 are approved. Let me now go to public comments on today's meeting, the Investment Advisory Committee meeting of January 25th. Anybody? No? But thank you, public, for being here. Okay, let us now go to fund and portfolio. I'm going to ask Treasurer, you want to just lead this conversation from this point?
Absolutely. Thank you, Executive
Great.
Ronayne. If we could, I think I'd like to have our staff start with our fiscal report that we produce locally, and then we can turn to the Meter team for the more global view and the portfolio details. So if we can do that, Eileen, would you like to go ahead and start sharing your presentation?
Sure. Let's just wait for Ricky to get the presentation up. Okay, you can go past, yep, keep going. All right, the next page. All right, thank you very much. Thank you, everybody, for showing up today. We appreciate it. So this is our, these are all of our fund portfolio. The top part of the general funds, the STAR account, the STAR Main is our STAR Main and our Key Bank, PNC, US Bank. Those are our operating accounts. We work out of them. If you notice that from last quarter from third to fourth quarter, our STAR Main did decrease. We had a lot of debt service payments, and with accounts payable closing, we were paying off a lot of invoices that they wanted to clean up their books. So that's why that explains that decrease. And then the other funds, I'm going to have Jed talk about the opioid funds. The only thing that I do want to talk about is the Israel bonds. We did make a $10 million investment in Israel bonds. We did stagger them. Some are maturing. We put $3 million to mature in 2020. Wait, $2 million to mature in 2025, $5 million to mature in 2026, another $3 million to mature in 2028. So we staggered it. We have a plan to invest another $6 million over the next year or so. We also have another $3 million that is going to be maturing in March. And so
What were the interest rates and what was the timing of those three investments?
okay, so the $2 million, the maturity date is 2025, and the interest rate is 5.36. So,
Not even close to anything we can get from anyplace else, right?
right.
Yeah, not for long term, right?
Then the 3-year investment was $5 million maturing on December 1st of 2026, and the interest rate is 5.39. And then the 5-year bonds were $3 million invested. The maturity date is December 1, 2028, and the interest rate is 5.59.
Whoa,
Yes. And so
great job.
I was in contact with our investor, and he is going to give me another rate. They just came out with another rate for the next round that we plan to invest when these mature, the ones that are maturing in March.
Well, there's every expectation the rates are going to start dropping here pretty soon. So
Right.
lock them in as soon as we can, because my son and I have a bet as to how many Fed funds rates are going to drop between now and the end of the year. And if they drop the minimum of 3 and maybe up to 4 or 5, those rates are not going to hold true. So we better get our money working as soon as we can. Would be my.
That's right.
What's that? Okay. Oh, it's just a cup of coffee. It's a cup of coffee. We don't bet crazy bets, but I'm betting 4. He's betting 3. 3 drops. He's our CFO.
Very good. The only other thing that I really want to touch base on, and then I'll let Jed take over, is we have been reviewing, the county investment team has been reviewing a lot of our current bonds that we have. And so some of them are extremely low rates. And so we would like to work together as a team and work with Meter and see if we can unload some of them. We'll do an analysis of it, and then we will bring it to you so that we can get your approval to possibly reinvest those in higher rates while we have the opportunity for higher rates. That's not a discussion for today because we have a packed agenda, but we're still working on that analysis. Okay? Thanks. Go ahead, Jed.
Thank you, Arlene. At our last quarterly meeting, we're asked to do a deeper dive into the Star Ohio opioid account and kind of analyze and see, what funds they had agreed to disperse and how long the Star Ohio opioid would last until we start tapping into the Meter funds. So the next, would you go to the next slide, please, Ricky? So this next slide here demonstrates essentially a summary of the conversation that we had, the Treasury team had with the opioid team to identify what kind of outflows we'd be expecting. And the bottom line, we're pretty excited to see the bottom line is that we would have about a little over 1.5 years after the end of this year to fund those opioid activities. So in the middle of 2026, our suggestion to council is that we start investing those funds that are in opioid sweep, about $20 million worth, so they start maturing in the middle of 2026. About $600,000 per month is what we would need to run operations. And I see a thumbs up, so I guess that means approval. But that's something we feel very comfortable with projecting that as a recommendation. We can see that the first quarter of this year, we project a lot more money to go out. Those are from contracts that the opioid team signed that concluded in 2023, but those vendors are allowed to invoice us 90 days following the conclusion. So that's why we have that larger tranche of dollars flowing out the first quarter.
Yeah, and just to clarify, all these are within policy. So there's no approval necessary. It's just more of an advisory
Okay.
heads up. So
Then we'll go forward with that. We'll touch base with Meter following the meeting and get those monies invested. Next slide, please.
Mr. Chairman, in regards to the set aside, we still have the $5 million set aside is that,
Correct.
that's not included in this number?
That's separate from this number.
That's what I
I'll be
thought, okay.
discussing that at the end of this presentation.
Not the stuff at the Cleveland Foundation, but we had,
Right.
Okay.
Meter has $60 million, to Sean's point. Meter has $60 million that they're currently holding. 40 million of that is currently invested. 20 million of that is currently in the opioid sweep. And so that $20 million in the sweep, that's what we're talking about here to invest with the maturities and the cash projections I mentioned earlier. But yeah, the 5 million is separate from the 60 million held with Meter. This is the opioid current investments. These are currently where they're held. These numbers, if we continue the same diversification, which we probably will, those will all go up about 50% by next quarter because we'll invest the remaining 20 million that's currently held in sweep. Next slide. At the end of last quarter, this was where we were as far as the opioid daily, or the Star Ohio daily rate. So that was the end of the quarter. The current rate as of this morning was 5.53%. Next slide, and then this is the Cleveland Foundation. This is the 5 million that Mr. Sean mentioned. You can see the 5 million that we have, and then the net investments income to about 216,000. We can all read. We're all literate. So there's the draft statement of what we have at the Cleveland Foundation. Those are also opioid innovation funds.
That investment gain over the period, that is the full calendar year last year?
Full calendar year last
Yes.
year.
Okay.
Yep.
Just a curiosity, I could take some of this at a later date if we're rushed today. Just our interface with Cleveland Foundation investment team, is that you guys interfacing? Is it our Meter team? Is it everybody?
We
Yeah.
interface with them.
Okay. pretty satisfied with the interface with, I'm asking because
he was-
they're essentially managing this fund, right? But we are reaping on behalf of our public, the benefits of that.
That is correct.
Okay,
Yep.
good.
On that sheet, though, I see a $9,167 admin fee.
Yeah, we pay a fee,
Yep.
To who?
The annual fee.
The administrators of the fund here.
correct.
That's clearly what I not had the expectation. I thought they were doing this as a public service.
No.
Can we go back and look at the original documents? Because I thought the creation of this thing. What's that? Wow, that's, Trevor, is that what your expectation was? I thought they were telling us that this was going to be a public service that they were doing on behalf when they originally said they wanted to handle the funds. Well, it wasn't just the intent. That's what the head of the Cleveland Foundation at that time had created the impression that that they were doing that as a public service. So whether or not the agreement that we signed ended up having that in there, I was under the impression that the prior executive heading that up was doing that for the good of the whole because they were committed to the opiate problem.
Councilman Strawn, is any of this in a public record, written or testimony that we can kind of refer back to with the conversation?
I think it is, yeah, because there's one smart aleck that usually asks those kind of questions and puts them on the right.
So suffice to say, we will look into it. Thank you.
Well, and it's just a multiplier effect. If this is in there for 10 years at $10,000 a year times X amount, that's, just to put it in terms of, that probably represents 4 or 5 lives we could be saving because there's 100,000 lives lost every year if we could do something of an effective nature. And, you know, they're only $4 billion. Do they really need our $9,000? It's you know, one of the largest in the entire country as far as public foundations.
Okay, thank you,
I
Councilman.
just wanted to add that the only reason it says draft is because I'm waiting for the final document. And so that should be coming out February 15th.
Okay. Well, I suggest
I don't expect any changes,
if
but,
there's a time to negotiate, it's in the first year.
okay.
All right, thank you, everybody. Brad, anything else on that?
No, I don't believe so. I think at this juncture, we're ready to move forward with our report from our friends at Meter, if they're still on the line there.
Okay, thanks again to the team that just presented on fund and portfolio. We now go to investment discussion with Jason Click and Jason Headings and their team. If you're here, did we lose them?
No, we are on. Good
All
morning.
right, we hear you.
And we have a new Jason with us this morning as well.
Keep it simple, that away.
Yeah, we are very intentional with naming of our associates. But Jason Zabo is our director of fixed income. Jason is joining today just to talk through the economic market, directional rates, and lead us through that discussion this
I'm
morning.
beginning to think there's a conspiracy at Meter. You can only get hired if you're a Jason. No, kidding.
Or you must be willing to change your name.
Yeah, that's right. All right, carry on.
Excellent. And with that, I'll jump in and do the economic slide. And if it's preferable for you guys, yep, you can run the slide deck. And for us, it's always good to end the year by looking back at all the events that really help shape, the geopolitical landscape, the economic landscape, social landscape. And it's really interesting to see its broader impact across the economics. And, really one of the big things that transpired over here in 2023 was the introduction to ChatGPT, taking the world by storm, and the revolution with AI impacting the labor markets. We've had a number of geopolitical events that transpired over the course of the year, whether that's the Israel and Hamas conflict. Also looking back this year, the U.S. is tracking down and shooting down the Chinese spy balloon that would cause certainly a number of tensions on the geopolitical landscape side. But really more importantly, when we look at the financial markets, really why we're here today is looking at a number of events that transpired over the course of over 2023 that really transformed, the capital markets, transformed the Fed policy. And, kind of working our way through this a little bit is some of the interesting things is recognizing we had another rating agency downgrade the U.S. as we look at the fiscal side of, the U.S. Treasury market has been certainly trending in a, not a positive direction. And we had another rating agency recognize that through the course of this year. It's hard not to look at one of really for the first time post the great financial crisis, we had one of the globally systematic important banks, Credit Suisse, on the brink of failure. And we had it was acquired by UBS, which really started with the regional banking crisis here that emerged here in March of 2023 with a number of bank failures on the regional bank side of the house that really transformed, and it's expected to transform the banking sector here in 2024 with a number of regulations coming out from the Fed and the OCC to really try to get a handle on preventing another regional banking crisis in the future. But with that, it created a lot of dynamics with the Federal Reserve. So the start of the year, there was a great momentum on the back half of 2022 with a continued expectation for the Fed to raise rates a number of times throughout 2023, but we only got 4 rate hikes. With all the volatility that occurred in the marketplace, the bank failures, the downgrades, geopolitical tension. We'll talk a lot about inflation here in a minute. But really, the Fed changed from being really, really aggressive to taking more of a, I'll say, passive and cautious approach as we had in 2023. And we ultimately, as we go to the next slide, we'll see one of the really unique things that occurred. And if you zoom in really in the middle of the screen, you'll see 2 colors, a teal and a green, which one of the real unique instances where the end of the year U.S. Treasury rates across the yield curve finished were exactly where they started. So despite all of this geopolitical and economic changes that are occurring over the time period, we really have one of the unique time periods where the rates market started where they ended, or ended where they started, excuse me. But really, it's kind of important from this chart is, and we'll talk about as we go through the deck, is if you look at the top hand, is where we saw the peak in rates here in Q4 of this year. And we'll talk a little bit as to why, exactly the Fed and the market started talking about cutting rates and driving interest rates lower. But really want to contrast that to the orange bar, where it's showing the U.S. Treasury rates going all the way back to 2021. And really 2 things is to recognize, yes, even though the rates have come down from their peak, there's still an incredible opportunity within the fixed income market to continue to take advantage of the level of rates that we haven't seen for quite some time, even just going back over the last 2 years. So there's still a great opportunity to lock in long-term earnings, but also to look at the shape of the yield curve. And the shape of the yield curve, going back to that orange one, is that positively sloped environment. But when you're looking at the yield curve today, go back to those middle 2 bars, it's the inverted side. So meaning that there's broad expectation, whether we're looking at the economic data and also on the inflation front and the Fed policy communication, and the market's anticipating that the Fed is going to lower rates here into the future, and it's still a great opportunity to again lock in some of the longer term earnings. And then as we head over to the next slide is really want to walk through some of the communication that we've seen. It's been communicated in the marketplace, and it sounds like and there's a lot of talk about the prospects of cuts in 2024. Is really want to walk through the reasons from the Federal Reserve's perspective why they think that's the case. And it really comes down to, and it started with a concept one of the FOMC speakers brought to the marketplace here in November, and he was simply asked a question, giving a speech on an economic update, really a question on what will cause the Fed to start thinking about cutting rates. And he laid out a very specific academic and policy answer, recognizing that there's been a tremendous amount of momentum with bringing inflation lower here in 2023. And the Fed needs to be very mindful of how restrictive they want their policy rates to be. And when they think about being restrictive, it's really recognizing the real Fed funds rate. So taking what the inflation rate is minus what the Fed funds rate is today, and that level of real rates really drives how tight their monetary policy stance is at its current time period. And what they want to do is, as inflation continues to fall in a very mechanical way, that if they were to statically do nothing and keep policy rates as is all throughout 2024 and 2025, the level of restrictiveness is going to get more and more extreme because inflation is going to continue to go lower throughout time. So if you look at the end of 2023, the real rate of Fed policy of Fed funds was about 2.15. So if they left the policy rate unchanged for the remainder of next year in 2025, the real rate is going to jump all the way up to 3.15%. And the Fed's going to be very mindful of trying to reduce the level of restrictiveness so that they can achieve their overall objectives of hitting that soft landing. So what they're introducing into the marketplace is the reason why they need to cut in 2024 preemptively is this: they don't want to have a high degree of restrictiveness that will cause a recession here in 2024. So they're laying the groundwork essentially of, as long as inflation keeps trending lower, they're going to have to cut rates so they can achieve the soft landing as their policy goal. And as we go over to the next slide, is really want to look through is, a positive aspect of something going on in labor markets is here locally in the county is in this chart looking historically at the national unemployment rate, the Ohio unemployment rate, and then here within the county looking at the blue line is something really, really positive. Is the unemployment picture is certainly better than the rest of Ohio, then also more broadly when we look at the national side. So again, something really positive from the local area with the employment markets being quite strong. And as we go to the
Jason,
next
Councilman
slide,
Tron has a question he'd like to
Yeah,
ask.
just by saying Jason, I covered three guys, so I'm not sure who's going to respond. But on the Fed rate, not just because it's an important cup of coffee bet, but because it actually has an impact on what we're doing when we actually float our bonds come August, September. How many rates are you, as our professional advisors, thinking we're going to see between now and August?
yeah, so from our perspective, we're going to be much more aligned as we'll go through the rest of the slides and look at the market pricing. We're much more aligned with the market pricing, and the market's pricing a much greater path for cuts. Reason being, really broadly, as you look historically from the Fed, they have typically are always too late to raise and they're too late to cut. And we tend to see, as we're looking at the economic data and what's happening on inflation, a very similar signs is that they're going to take their time thinking about cutting, and the economy is going to continue to slow and result in them having to cut more rapidly than what they initially lay out. And one of the things to also keep in mind is the Fed is very careful when it comes to what they call forward guidance and communicating to the marketplace. So when they introduced here in December cutting rates to about 3 times or 75 basis points in 2024, they're trying to also be mindful of not introducing too many cuts so the market doesn't get too far ahead of the Federal Reserve. So they sort of massage a little bit their forward guidance to really manage the market as well. But from us, we're definitely going to be a little bit more aligned with where the market pricing is today and expecting more cuts than what the Fed is communicating at this point, given what we've seen in inflation, then also within the rest of the economy side.
Well, I wasn't trying to chastise the Fed for whatever they're going to do, because they're going to do whatever they're going to do. But I'm trying to get, what is it you as our professional advisors think is going to happen in regards to that? Because we actually have to float a lot of bonds come August, September. And every one of those quarter points results in hundreds of millions of dollars over a 40-year period of time. So what is your best guess? We're only going to get one shot at it when we float our bonds.
Yeah, and right now we would be
And make sure it's
aligned
correct, by the way, whatever you give us.
Yeah.
Right now, we would be very aligned with market expectation when we're looking between here and August. Really looking, I mean, the market's priced in, I believe 3. It's been going back and forth between 3 and 4 over that time frame.
Okay.
So that's where I think we would fall on this, given today's
Information, right.
Okay, thank you.
All right.
Perfect.
keep
So then
rolling?
we'll go,
Yep.
yeah, sorry.
Go ahead, keep
Yeah,
rolling.
so we
Yep.
really want to dive in a little deeper as to, whether from Christopher Waller, but then more broadly from the rest of FOMC, why are they talking about restrictiveness in the case for cuts? And it's really the left-hand side looking very broadly at a number of different measures of core PCE, core PCE being important as this is the Fed's view of what's the best measurement of inflation as opposed to CPI from a methodology perspective. And it's really important as you look at that sort of teal color, that's the year over year number, and it's certainly a bit more elevated above that 2% inflation goal and mandate from the Federal Reserve. But when you look at more recent trend, and that's looking at the 3-month annualized rates or the 6-month annualized rates over this last back half or last 6 months of 2023, we saw a significant deceleration in inflation getting much closer to that 2%. And this is really, why the Fed is talking about the need for cutting rates, is that they need to be ahead of getting the year over year number to achieve that 2%, in order to avoid being overly restrictive and seeing the number of evidence from more recent trends. And when the Fed talks about policy implementation, and this was a big point of Christopher Waller's speech, is yes, from a communication, whether looking at the summary of economic projections, they typically look at year over year and communicate year over year. But when it comes to policy implementation, they look at more shorter trends, particularly the 6-month changes in inflation, to really help drive, the policy goals and objectives that they're trying to meet. So here, this last year, we saw significant signs of inflation coming lower, and it's really on the key measures. But when we look at the right-hand side, is going to walk through a couple things, is break through some components of what's driven inflation lower. And a lot of that has broadly had to do with the goods sector. And that's that, again, teal color that's been, coming significantly lower. It's well below that 2% and getting closer to alignment with pre-pandemic, where the goods inflation numbers were coming in on a year over year and a month to month basis. So we've seen a huge drop from overall inflation from goods, but we also seen core services, excluding housing, and that's that green color, have a deceleration all throughout 2023. And one of the really important factors that the Fed is recognizing is what's been occurring within the housing market. So even though that darker blue, it's significantly elevated, it's coming down. But from the way PCE and inflation measures housing, there's a lot of nuance in its methodology and its calculation. And this is really a lag value. And what the Fed is recognizing, that when they're looking at more real-time rents, whether that's a commercial or an apartment side, the rents have come down significantly here in 2023. And then the actual measurements, whether that's in PCE and CPI, are going to really start to reflect that disinflation we've seen in housing really take hold in 2024. So there's a ton of momentum set up for 2024 to continue to see inflation fall as we saw throughout 2023, and really laying that groundwork for the Fed to cut rates in 2024. And as we go over to the next slide, is zooming out beyond inflation. One of the things we continue to take a look at is what's going on on the economic side besides inflation. And one of the areas, because given the time and its robustness, is looking at the leading economic indicators. And this is a set of about 10 indicators looking across a number of different areas throughout the economy, and really trying to gauge of what's the turning points and momentum of the U.S. economy, to gain a perspective on, are we growing or decelerating? Are we heading for a recession or not? And what we've seen is the leading economic indicators continue to decline for what has now been a record 20 months in consecutive fashion. And it really gives us caution in looking at the economic environment, with the weight of policy rates going from 0 to well over 5%, the lag effect that it does occur. We're certainly seeing growth in the economy continue to slow down. It's certainly represented from the leading economic indicator side that, there's broad expectations for the economy continue to slow and recalibrate itself, that the signs of recession are still in a number of areas within the economy that are giving us caution. And then as we go to the next slide, is we'll kind of reconcile. So we talked about the Federal Reserve is communicating 3 cuts in 2024. The market at different points in time, it has been pricing a more aggressive path lower in Fed policy rates. And that's a function of just recognizing the inflation outlook is very positive. And then secondarily, as the market is looking at the economic data, it's also recognizing, yes, labor market and the employment side has been slowing. We've seen manufacturing sector slow significantly in 2023. When they're looking at the regional Fed, puts out a regional Fed surveys, And a lot of the survey-based data is continuing to point to economic weakness. So the market is also pricing in not just inflation success, but also the slowdown in the economy that's going to result in the Fed needing to be more aggressive with trying to achieve a soft landing by needing to cut rates more than what they've initially communicated. So with that, I'll open it up to, I went through a lot and somewhat relatively quickly, so I'll open it up with any questions anyone may have.
Any questions?
The only thing I guess I'd ask Jason is, and we're probably going to get into this in the portfolio review section in just a moment, but, you know, looking at where we're going with respect to rate cuts in 2024, you know, what the strategy looks like for locking in some of those better rates for more duration in the portfolio. I know that's one of the things the committee is probably very interested in hearing. So if we're going to cover that in a second, that's great. But I did want to make sure we asked that question and what we were looking to do in that area.
Yeah, great comment, Brad. I'm going to get into that as we transition into the portfolio review and talk specifically around strategy.
All right, great.
Great,
Anybody else?
fantastic transition.
Okay, let's transition.
So as we
Portfolio
go in,
review.
we're going to start off as we normally do with the core portfolio on the next slide. No dramatic change in terms of money coming in or money going out of the core portfolio itself. So focusing in the upper left, the total portfolio the core portfolio stood at the end of the year of just over $944 million. Focusing on the left-hand side middle, next, the weighted average maturity, specific to Brad, your comment, the weighted average maturity of the portfolio stood at 2.55 years, up from the prior quarter. And the weighted average yield overall, again, up from the prior quarter at 2.52%, putting us on target for a 1 year or an estimated annual income of just shy of $24 million within the core portfolio itself. Specific to allocation, the upper right-hand corner, the big changes, some of which have already been discussed here this morning. We were able to identify those Israel bonds. We have that allocation back out to the 2% limit within the core portfolio itself. The majority of the other repositioning that occurred and is continuing to occur is happening on two fronts. One, anytime there is a maturity within the portfolio, we are actively moving out to the long end of the portfolio to lock in those rates for as long as we can. There is an effect that does have on the overall allocation of the portfolio. So just for everyone's benefit, as we are restricted to a higher revised code, when we're going out beyond 3 years, you're going to see 100% of those reinvestments occur within U.S. government agencies and or U.S. treasuries. Those are or the Israel bonds, again, which we talked about before, and those have already been put to work, but at a 2% maximum, a small part of the portfolio. The larger part of the portfolio, you will see the two pieces of the donut chart here, 52% U.S. government agencies and 29% in U.S. treasuries. We would expect that trend to continue, again, with the intention of locking in those longer term yields for as long as we can and having that universe of options shrinking to us as we go out longer on the yield curve.
And
The maturity
just a
Go
question
ahead.
on the point. Do you anticipate, it's hard to, have a crystal ball on what happens down south, but do you anticipate that window to get narrower for us, narrower than the 3 years you stated? On the basically the direction of U.S. Treasury only for X period of years?
So we are expecting that trend to continue as long as we are planning to lengthen the weighted average maturity of the portfolio, which that is the strategy that we have been employing and we will continue to employ in direct reaction to not only what has occurred within the rate environment to date, but also the general expectation that Jason Szabo discussed moving forward. The key here is, look, we can debate, is it 3, is it 4, will it be more, will it be short, faster, slower? But in the end, we are all can agree on the fact that the directional trend of rates is down. So we want to make sure that we are locking those yields in as long as possible. So back to my earlier comments, I said there are two ways. One's the maturities that I just described. The second are any opportunities for swapping securities. Eileen talked about this. We did an evaluation of this in the middle part of last year, which we reviewed as a committee prior. We continue to look for opportunistic ways to swap securities to increase the yield or lengthen the maturity of the overall portfolio. We've made a number of those moves. And again, as Eileen described, we're doing a more wholesale review to see if the math works to use those opportunities to our advantage within the portfolio itself.
Jason, Councilman Tron has a question.
Thank you. The 2% were maxed out on the Israeli bonds at this point? I didn't think we were based on what I thought I heard.
No, not yet.
Okay, can we?
Only on the core, but as this group may recall, when the policy itself actually relates back to all of the county's funds. So we have short-term cash, we have some of the opioid funds, so there still is some room. I was simply identifying here within the core portfolio itself, we are at that 2% allocation.
But, so, well, I thought I heard both. If there's funds available that we could do an investing on, the 5.6, I think you said, for 3-year earlier, on the Israeli bond versus 2.5, that's more than double. We should put every penny we've got to the maximum, out for the maximum period of time, it seems, and anything we can do. Can we buy options on Israeli bonds too? Or can you only buy the bonds?
I think it's the
You
bonds.
can only buy the
themselves. Yeah,
bonds.
and the longer term portfolio strategy is to be at 2%, which is our statutory maximum. So we're getting there. That's where we're going to be by the end of the year, I imagine, across all of the portfolio.
But the same thing with U.S. Treasuries. We ought to buy, I mean, I don't think they're going to be any higher for the next, if there's going to be at least 3 rate cuts, 4 rate cuts, who knows, 5 or 6 by the time we get done with this, we ought to be dumping it in as much as we can for as long as we can, if we don't need the liquid cash.
Well, and I appreciate you mentioning that because I wanted to ask a clarifying point and maybe make a clarifying point, and that's that the overall portfolio policy, which we're going to be having a conversation about shortly, has a maximum in it, I believe, presently, maximum maturity or maximum duration in it. So there is a ceiling to how far out we can go on the maturities, right? So that's, I just wanted to make that point as well. We're at 255 presently.
255. Yeah.
I think 3 is the outer bound of that, or will be soonish. So just something to keep in mind.
But I thought if they were buying U.S. Treasuries, that constraint was not the same constraint.
It's a constraint for the overall portfolio.
Right.
So, they can go out to 5, but that gets calculated then into the overall maturity.
Okay.
Yeah, of the whole thing. Thanks, Jason.
Anything else?
Yes. Transitioning on to the next slide, just a quick compliance review. Everything within the compliance standards, as discussed before. Transitioning quickly over into a yield review. The portfolio stood at 2.52%. As described, we're always looking against a much shorter benchmark of the 2-year Treasury, a 2-year average of the 2-year Treasury at 378. And then we know that the overnight rates within Star, Ohio still remain high, but we have seen that level off and even begin trending down to an extent as short-term rates are coming in as well. Over into the opioid settlement portfolio, Jed described this in more detail earlier, but just so pictorially everyone can see, there's a total portfolio amount here in the portion overseen by Meter of $61 million, split approximately 19% in the settlement fund Jed described, which is going to be reallocated now that work has been completed, and securities of just over $40 million. The weighted average maturity much shorter, which will now be effectively lengthened as securities are placed into the portfolio, matching expected distributions. The weighted average yield of just over 3.3, generating an estimated annual income of just about $1.4 million. You can see, again, similar or in line with the core portfolio, the majority of the allocation out between agencies and treasuries, with some portion in both corporate notes and commercial paper. But down in the maturity distribution, a much shorter allocation, as we've all been talking through as a committee, waiting on final decisions around the ability to lengthen. And then I'll finish up with the compliance review of the opioid fund on the next slide. Again, all within the compliance standards. I will close there and open for any questions and or comments.
Terrific. Any questions?
Well, the only comment would be that if you look at, because of the vehicles they can use over Cleveland Foundation versus the vehicles we're constrained to do, if we were to convince my colleagues to move the other $5 million in, it would actually be performing better because of that over in the Cleveland Foundation. And so I would hope that we could convince everybody, but perhaps you can work on a few of my colleagues in that respect to get it the full $10 million into there, because just looking at the results, they just have a little more freedom to what they're doing versus what we can do here. And so that means ultimately, when we follow the path, we're going to save more lives, I believe, ultimately, by doing it that way.
And would lessen the blow on the fee conversation.
It's going to be a success. I have no doubt about it. We're going to come back and say this is one of our capstone successes in the county.
Anybody else for meter? Always thorough and appreciate the detail here, guys. Any questions for us? Good? It's good to see you.
None on our side.
Okay.
Thank you.
Well, thanks for all you're doing. Happy New Year, and we'll see you at our next meeting.
Sounds
guys.
All
great.
right. Thanks, everybody.
Thank you all.
Thank you.
Bye-bye.
Great. So we will move into, unless there's any comment or question on what we just saw. Good. We'll move into other business, and I think we're going to look at the investment policy review and amendment.
Great, yeah, thank you, Executive Renee, and all of our meter friends who are now off the call. Thank you for being here as well. So just getting into the investment policy review and amendment, you all should have a draft policy in front of you in the portfolio packet. Just a couple of points on this. So the reason that we're having this conversation today is that the last time I think we did a holistic review of the investment portfolio was in 2021. Traditionally, this is something that counties do at the first meeting of a year, is to take a look at the portfolio or the investment policy to see what needs updating and make an adjustment. So in light of the fact that it's been a while and it's a common practice to do it at the first meeting of the year, we felt it made sense to bring this to you. What you have before you is something that is the product of doing a review of investment policies from Portage County, Summit County, Franklin County, and then having a conversation with our friends in the prosecutor's office, as well as Jason Headings from Meter and my staff. So just to kind of capture the essence of most of what is here, this is a discussion copy. I think our plan is to have you review this today and think through some of the changes that we discuss. I think we have sent you a red line copy, but if not, we can get you a red line copy so you can make comparison points versus what was in there previously. But then to have this be something we can approve at our next meeting. So I know the effective date says January 25th on there, just to point out that's a placeholder. So substantively, what we're looking at in terms of additions are this first section on page 1 where we talk about membership meetings and minutes. This is a best practice to identify in the policy who the members of the committee are in ORC. And that would be the 3 of us. We can expand it if we choose to do so. That's something that we are supposed to consider potentially at the first meeting of every year. Also to set a meeting schedule for the year and some expectations around what minutes look like, what records look like, where they're stored, how we manage those things. So that's what that first section is. I think in terms of other things that are substantive changes, we've restated what the person rule is on page 2. That is in the current policy, but that is a more fulsome explanation of that piece. We have shuffled around some of the pieces so that they flow a little bit more consistently and logically. So ethics and conflicts of interest follows that. Scope of the policy would be the next section. This, again, just restates anything not clearly authorized under these policies is prohibited, with the exception that the committee can always approve something that goes beyond kind of the durational limits and some of those sorts of things that are set out in there. So the next piece is the investment objective section. This is, once again, pretty standard and comes straight from the ORC, but we have compliance with state and federal law. In order of importance, safety of principle, we need to keep the cash that we hold safe, maintenance of liquidity, that we're able to pay the county's bills where necessary, and then maximizing return being the third of those priorities. Again, nothing terribly different there. It's just kind of spelling it out in a little bit different way. Procedures and limitations is something we pulled over from the prior policy as well. And then the next section you see is highlighted. That's the authorized investment section, starting on page 4 into page 5. And then also carrying forward into the portfolio diversification section on pages 7 and 8. I want to flag that for you as something that we might consider consolidating in our conversation with Meter and reviewing other policies. Many policies do not spell out in the level of detail what those authorized investments are and what those portfolio diversification bumpers are. That speaks to giving us a little more flexibility within the bounds of the ORC. So many policies simply say, investments will be any authorized by the ORC, subject to review basically by the committee, that sort of thing. So
Is there anything in this highlighted section that would put us currently out of compliance?
I didn't indicate anything in our current view, so I don't think that this section has changed since 2021, but the ORC sections do change occasionally, and the way that this is written presently, that introductory paragraph says that we can invest in anything authorized by the ORC subject to the following limitations. So that would be very easy for us to fall out of compliance or something to change. So that's, again, why we flagged that as something we wanted to take a look at. On the diversification section, most of what is in the table there that you see before you is from the ORC. So those bumpers are not anything that we've set up that are unique to Cuyahoga County specifically. We'd see foreign notes are added there, 2%. Most of that is again in the ORC itself. So there's nothing there that we think wouldn't be covered if we didn't consolidate that a little bit. So, again, as you review this and think about it, if you have staff think about it or review it, that's something I think we're interested in simplifying as we go forward as well. There is a provision.
You heard that, Trevor. Staff? Okay, good.
That's good, yeah. Moving forward then through the rest of this, prohibited investments and investment practices. Again, that's kind of a recitation of ORC. It's fine, I think, to leave the things we're not allowed to do. In many ways, policy is meant to be spelling out where those restrictions are. There is a provision here, and in the red line copy, it's a little clearer, that speaks specifically to linked deposits, which we're going to get into shortly. Oftentimes, those we want to create a provision of the policy that speaks to the existence of those, and that we can create those in part because they are an intentional reduction in return. So we're not getting market rates, but that's on purpose because they're serving some other public policy goal. So that's added in here. I'm not finding it right away because I'm trying to do this in 2.5 minutes, but that's in there as well. So just so you are aware of what is present there. On page 9, the present policy, this draft and the present policy both contain a section on bank selection and review. We recommend removing that because it's covered elsewhere and not really about investments per se. That's a little bit beyond the scope of what typically might appear in an investment policy. So something we would encourage removing from the policy itself. The balance of this, competitive selection, investment of proceeds, safekeeping, et cetera, is all relatively unchanged from the prior policy. It's just formatting. And then the last section on continuing education, specifically spelling out that staff are included in that. And then having provisions here that do treasurer recommendation, capture that the Treasury is recommending these changes, that the investment committee has approved it, and then that last section on page 12, that it's been acknowledged by typically this would be signed by any broker-dealers. The way that many counties handle this is that your investment manager signs it on behalf of all of those, and then they're responsible for the record keeping as to their broker-dealers' compliance with the policy. So that is a very quick recitation of what is proposed in there. The balance is just glossary of terms used in the policy. Again, largely unchanged from the prior and existing policy, but this is something, again, we'd like to consider at the next meeting for broader approval. So having said all of that, any questions?
Yeah, I'm glad you took this up. I have none. Jack, do you have any?
Only question is, at one point, I think we had added the ability to debt from communities and school boards and things of that nature. We had, I thought, changed the number of years that you could go out. Initially had a shorter window on it, and I thought, has that been included in, updated in here?
I believe, Councilman, that that provision is in here, but I will double check that. And it's certainly included in the ORC. So to the point I was making a moment ago, if we were to change the language to something that's a little simpler and saying so long as investments are, authorized by the ORC, that would then allow us that opportunity to do manuscript debt and some of those sorts of things you're discussing. The durational piece, I'm glad you brought up also. The policy as it stands now, as we were talking about that today and going out longer, talks about portfolio duration. At Meter's suggestion, we changed that language to weighted average maturity, and the bounds that are suggested here are no more than 3 and no less than 1 year, so that you don't end up too far on either side of the barbell with the core portfolio. So
You're talking about to loan to a school board or to?
just generally, I switched
Oh,
gears
well,
a little
that-
bit in the middle of that answer. So
Okay,
yeah.
having a
Yeah.
former mayor here, 3
Yeah.
years ain't gonna cut it. You get.
No,
If they're going out to float a bond for an issue of a school or school board, they're gonna need to have something about close to market. They can't live on
yeah,
a 3-year debt.
that school board debt would be a policy exception that the committee would
Okay,
have to
I just wanna
approve.
make sure we got that
Absolutely.
covered because
Yeah. I'll
clearly-
double check that though, for sure.
clearly if
It's
the
in-
interest rates are gonna be dropping and you are a community, you would love for us to both participate. We can make more money and they can save money.
Right.
And we just missed an opportunity.
Yep.
I didn't hear us mentioning out there to all the mayors that were in the other room, that we've got millions and millions of dollars that we could be
Yeah.
being your backstop
Well,
and saving you.
And I think your point's well taken. Why don't we look into it? I want to measure twice before I cut and speak to them, but we got meeting every month with them, so.
They should be, I mean,
Yeah.
and everybody says, well, you mentioned it last month, a year ago. No,
Yeah.
it takes 7 times to make a presentation on sales
Yeah.
before anybody hears it.
Jared has something.
On page 6, we do identify the school boards and school districts.
Thank you.
We can have maturities up to 10 years.
Okay, we did it, okay.
Yeah.
It went from 5 to 10, that's what I thought. Okay.
It is to 10.
And again, if we were to go beyond that, we could by voting.
No, I
today.
think 10 years is, I mean,
Yep.
most school
No,
boards.
I think let's talk about how we get that out to the mayors. Agreed. What else? Anything else?
In terms of the policy itself, that's it. So again, this is more of an advisory. We're thinking about this thing we wanted to put before you today. So if you have feedback on this before the next committee meeting, we wanted to make sure we gave you an opportunity to provide that because it's a lot to digest,
Yeah.
obviously. But I think that'll serve us well going forward. And then going forward, a provision of the policy change requires us to look at it every year because I think that that's a good practice just for us to be in the habit of reviewing it. And that can be as simple as, yeah, we like it. It's fine as it is, but something that we should potentially do and have on the record as having done. So
And on that point, I want to thank the team. I think you've cleaned up some things, particularly just good to have this policy in front of us at first meeting. So thank you for that and the thoroughness putting this meeting together. We're not done yet, but for the meat of the meeting, appreciate that. I am time bound here in a minute, but I think we've only got 3 more items.
yeah, I'll go through this quickly.
Okay,
Yeah. So election of chair and other officers, you noted at the beginning of the meeting, we weren't sure who called the meeting to order. We don't have a formal
Yep.
chair. The ORC
requires it.
requires
Yeah.
us to name a chair, so I'm suggesting we elect officers, chair, vice chair, secretary. That is in the policy. If we had passed the
1, 2,
policy.
3,
we
how
would
about
have,
that?
Yeah.
so we would need a motion. to
I
that
don't-
Can we
effect.
motion
Chairman?
ourselves? Go ahead.
I nominate the county executive, the chairman.
All right, now, should we take these individually? I'll take
Probably.
a second on that.
Second.
And all in favor?
Aye.
Aye. I'm going to motion Councilman Jack Schron, vice chair.
Second.
All right, all in favor?
Aye.
Aye. And
And what was it, the third one was the
Secretary.
Yeah,
secretary for meetings?
Yeah.
I nominate the
Cronin.
treasurer for,
Yeah.
yeah,
Secretary.
we're going to, go ahead.
I nominate the treasurer and the
Treasurer.
secretary?
Okay.
As the secretary of the committee, did we catch
Of
all
the-
of
of the committee,
We're
yes.
just moving in the
I know we're
whatnot?
moving fast. Got it? All
Okay.
right, and I'll second it.
Excellent.
Yeah,
All
1,
in
2, 3.
favor?
Is there-
Aye.
Aye. Thank you. That was quick. All right, but good work. Then we're going to meeting dates for fiscal year
Yeah, meeting dates,
2024.
thank you, executive. Meeting dates you have there, we've checked with staff, and those dates are free for everybody, so we'd like to lock those in and
Good.
get them on the calendar so we can advertise them and
Okay.
comply with the law in that way as
Good.
well. So
And a question, if in the event, because schedules do change, proxy is still okay as?
Right, and if necessary, we can move the dates and just
Okay,
re-advertise,
Great,
so.
great. Okay?
So
Okay
we
with
need
that,
to
Councilman?
Vote to
All right.
approve those.
Link deposits?
Can we have a vote to?
Oh,
approve?
yeah, I'm sorry. Let's
That's all
move, can I ask for a motion on the dates for 2024 meeting dates? Thank you.
moved.
Okay, I have a second. Okay, thank you. And all in favor? Aye.
Aye.
Aye. All right, link deposits, very briefly on that. So currently, the county has two link deposit programs, Heritage Home and the HELP program. The last time those were reauthorized in a fulsome way was in 2012, 2013. There is opportunity in the rate environment as we have it now to do more with those programs to pursue public policy aims. So our office is in close conversation with the Office of Housing and Community Development and others on some proposals that we can do that we'll be putting forward soon to do more in those areas. So we'll look for that as an agenda item in the spring.
Great. Again, thanks to the team for the materials for today's meetings. If there's no further question.
The only one comment is when we did this 3 years ago, 4 years ago, of the policy review, we made that a major portion of the entire meeting so that it got its due difference, and then we put all the financial updates
Okay.
as a secondary. I'm just.
No, I'll take
I'm
that as a
saying
recommendation for the
This
next
is a,
meeting.
this is a big
Yeah.
deal, and we want to make sure we
Good.
dot out of the i's.
Yeah, I agree. I agree. Okay, duly done, and we'll move forward. I'm going to ask for a motion to adjourn.
So moved.
Thank you. And second, no, all in favor, aye. Thanks. Enjoy. Oh, yeah, I got you. All right. No, thank you. No,